Abbas Barkhordar. I'm the co-manager of Schroders Asia Pacific Fund. So if we go on to the next slide, you can see we're just going to cover the investment approach briefly at the start before I start talking a little bit about the fund's exposure and our positioning and the opportunities we see in the region. So on the next slide, you can see just a quick summary of our investment philosophy. And hopefully it shouldn't be surprising to hear that, we believe Asian markets are inefficient and that there's good potential to add value through active fund management. That's our job. We believe that value is best extracted using a bottom-up approach. So that means stock picking more than, say, country or sector allocation. We obviously do need to be mindful of the sort of top-down risks and the country and currency exposures of the fund. But fundamentally, we approach the portfolio construction from a stock selection, bottom-up fundamental analysis of the companies that we're buying. We think that's the way to extract the most value from this process. That means analyzing all sorts of aspects of companies' operating models and the sustainability of how they operate, not just in the traditional sort of ESG sustainability sense, but in the sense of how long they can maintain supernormal or above cost of capital returns, which is what we look for. We have a quality bias in the companies that we look for, looking for those companies which can earn above their cost of capital over the long term. Those are the companies we think can compound and add value throughout time. And to do that, requires a disciplined approach, consistent approach across a very wide opportunity set across the region. And to do that, we have a strong team based in the region who do that fundamental analysis work on the companies and industries that we invest in. And if you go to the next slide, you can see a little bit more detail on that team. So as I said, Richard Sennett and myself are the co-managers in London, but we have a team of 44 analysts based across the region in 6 offices. You can see there's a good spread of analysts geographically. And the important thing is these are an experienced team of analysts who understand their markets very well, know the companies that we're investing in, and the managements and the track records and the industries that they operate in. They know those industries and companies very well. We rely a lot on their bottom-up fundamental analysis. Obviously, we do our own research as well, and we travel to the region regularly. But the key source of alpha for the product, for the trust, is that experienced team of analysts on the ground across the region. Clearly, being based in London, Schroders also has a huge amount of research resource available to us here. The core team is in Asia for the trust, but we have a lot of additional resource in London, whether that's the central economics team, the sustainability team, the data insights unit, the data science team, who's feed into a lot of the stock research that is done. They're based in London, as well as the broader team of emerging market analysts and global equity analysts and fund managers, who obviously we have a lot of interaction with and discuss ideas with. So a huge amount of resource in the region, but also benefiting from the resources available to us in London. So that's the theory. That's all very good in theory, but in practice, does it work? Well, the next slide hopefully demonstrates that there is a track record of consistent long-term outperformance. This is the performance of the fund relative to our reference benchmark ever since it launched just over 25 years ago. And yes, there are periods of up and down. Clearly, that is part and parcel of active fund management. There will be periods where our approach works better than others. But over the long term, and we do have a long-term investment horizon with our investment approach, we have added value consistently through that disciplined approach using an experienced team on the ground. Clearly, the members of the team, the fund management team, the research team have changed over that period, but the consistency of the approach and our belief in how to add value in the region hasn't changed, and that consistency of approach continues going forward as well. Clearly, past performance is not a guide to future performance. Please do read all the disclaimers carefully. The next few slides have more details on the performance and disclaimers, but I'll leave you to read those in your own time. Of course, if you're considering an investment in the fund, then please do read all of our disclaimers carefully and make sure you understand them. So moving on to slide 9, after those ones, just to sum up the investment approach. As I said, the slide 9, please. So a few more. Summing up the investment approach, what sets us apart? clearly, it starts with that large on-the-ground team of experienced investors who cover the region and have done for many years. That team is applying a time-tested, disciplined process, which really focuses on quality of the companies that we're investing in, with a disciplined approach to valuation as well. So making sure that we understand the fundamental value of the companies we're buying, and looking at the sustainability of their business models so that we can have a long-term track record. And that track record is one of consistent outperformance over the medium and long term. So that's the investment approach. Where does the fund position itself now? Moving on to the next couple of slides, you can see on page 11 where our active country positions are as of the end of March. And I should say, again, emphasize, we don't allocate based on a country or sector view. This is just giving you a snapshot of where the portfolio sits as a result of all those cumulative bottom-up investment decisions that we've made on a company-by-company basis. But there's some interesting themes that we can draw out using this framework. Probably the most obvious point to start with is our very significant underweight to China as a market. Now, that is an underweight that we've had for a considerable length of time. It's quite a consistent positioning of the trust. You can see, obviously, China is a large and important market for the region, and it's still one of the largest absolute weights in the portfolio. If you look on the left-hand column of numbers, it's only, the only markets which are larger in size are India and Taiwan, but it is still a very large underweight relative to the reference benchmark. And the reasons for that are really more structural than cyclical. Yes, China's economy is currently going through a lot of challenges, but we think actually many of the concerns we have with investing in that market are quite structural. There's clearly, a number of companies which don't meet our requirements in terms of the governance and the quality, the shareholder focus that the management teams there have, or alignment of the majority shareholders with minority foreign investors like ourselves. So for companies to get into the trust, we need to be pretty comfortable in terms of their governance and the quality of the management, as well as their interest in looking after the interests of shareholders like ourselves. Many companies in China just don't meet that threshold. And then many of the ones that do are at valuations which are still quite hard to justify, despite the market's poor performance in recent periods. So we end up with quite an underweight position in China, and I think that's likely to continue. Some of those issues around the property market, for example, geopolitical and domestic regulatory issues, those are not likely issues to be going away anytime soon. So there are a number of headwinds in China, which explains why we're quite significantly underweight there. On the flip side, you can see the markets where we are more positive. One of those is Hong Kong, which historically has been quite a separate market to China, and there are still some very important distinctions to be drawn between the Hong Kong market and the mainland China market. One of those, obviously, is the lack of capital controls in Hong Kong. It still has a freely traded currency, and generally we find the standards of corporate governance, the quality of the companies there, and the focus, importantly, on shareholder returns and safeguarding shareholder interests in Hong Kong is quite a lot higher than that in the mainland. Our holdings in Hong Kong are a mixture of sort of global exporters, as well as those which are more exposed to China, Hong Kong, and indeed the wider Asian region. So it's a bit more of a diverse market, and holdings we have in Hong Kong, which allows us to be quite overweight there. There's more companies that meet the governance thresholds, and generally as well, valuations are more appealing than in the Chinese mainland. Another market we're overweight is Singapore, which actually has benefited a lot over the last few years from some of the companies which have left Hong Kong, or people who have relocated out of Hong Kong to set up the regional headquarters in Singapore. We like that market. Again, it's fairly inexpensive on a regional basis, but more importantly, it has good quality companies with very sensible management who make good capital allocation decisions and do have a good sense of rewarding shareholders with sensible shareholder return policies. So we find a lot of opportunities there in the banks, but also in other sectors. one of the advantages of being an active manager, of course, is that we do have the opportunity to invest off the benchmark. So Asian countries that aren't necessarily included in the benchmark, places like Vietnam, which do offer some opportunities from a stock perspective, where we know the economy there is doing fantastically well from a FDI perspective, attracting a lot of foreign investment into the manufacturing supply chains that are relocating across Asia. And while the opportunity set in terms of stocks is fairly limited at the moment, it's a market where we see the potential for lots more listings, lots more opportunities for stocks to come to market and raise capital as that supply chain shift continues. So that's one of the off benchmark positions we have. We also are overweight generally a few of the ASEAN markets, so places like Philippines, where we do see some opportunity as well to add value. This is an area where the market has not necessarily become quite as deep as we'd like. Markets like Indonesia, where we're quite positive on the top-down picture, there are limited opportunity set from a stock liquidity point of view. There are obviously some stocks that we can invest in, banks, and given the investment trust structure, does allow us to go a little bit lower down the market cap and liquidity thresholds. That is some opportunity that we're looking increasingly to exploit in places like Thailand, Indonesia, and Philippines. What I'd say on the flip side, we do often get quite a lot of questions about our holdings in India. As I said, actually, India as an absolute proportion of the fund is quite large. It's the second largest country, but we are slightly underweight the index. And the reason for that is going to become obvious when we move on to the next chart, as well as Korea, where the valuations are really quite extended at the moment. So if we move on to the next slide, this just gives a snapshot of the valuation picture by country across the market. And really the point of this is just to show how mixed that picture is and how diverse the sort of spectrum of sentiment that is represented across the region has become. And that obviously is an opportunity for adding value for active fund managers, as we can obviously pick and choose between the countries depending on where we see the valuation upsides occurring. So you can see here, it's a little bit of a complicated chart, but if I just explain briefly, the blue diamond is where the current valuations sit, and we've put that in the range of where those valuations have been since 2010. And what you can see there is, countries like India, where there is a very positive macroeconomic environment and a huge amount of positive sentiment, that is increasingly priced into markets, and it's looking towards the top end of its range when it comes to valuation. We see the same story in Taiwan, a market with a lot of tech companies, where the AI excitement has led to a bit of froth appearing and valuations being towards the top of their range. I mentioned how we like some opportunities in ASEAN, and you can see there countries like Malaysia, Indonesia, Philippines, Singapore. Those are towards the bottom of their ranges, and clearly Hong Kong and China on the right-hand side there as well, looking quite cheap on an optical basis. I should say, obviously, when you look at the pure valuations, you've got to bear in mind what returns look like in those countries as well, return on capital. And I would say that China, for example, the outlook for returns there has materially deteriorated compared to a few years ago. So you can't just look at the valuation and think that looks cheap without considering the return environment. Moving on to sectors on the next slide, I'll very briefly just touch on our main exposure. So we are very overweight financials and information technology. Financials is a very heterogeneous sector, very diverse. It includes companies in insurance, but also stock exchanges, banks, and even within banks, you've got countries like India and Indonesia, which are very different banking markets to places like Singapore and Hong Kong. So a very diverse sector, quite unfair, I think, to sort of lump it all together. But IT is a bit more of a coherent sector in the sense that in Asia, largely the IT exposure is in tech hardware, and particularly our exposure, we like many of the semiconductor names in Asia, which I'll come on to. Now, some of that overweight is funded from what are traditionally viewed as slightly more defensive sectors, things like utilities and consumer staples, which generally we find pretty expensive across the region. So we are quite underweight there. And as you can see, that the fund is moderately geared, about 3% geared as of the end of March. So moving on to why we like financials, on the next slide, you can see that across the region there is a wide degree of differences in terms of penetration. Markets like Indonesia and India, where bank credit is still quite underpenetrated relative to GDP, and that really suggests that there's quite a long runway of growth for banks in those markets to be able to grow into. On the other side, you've got more mature markets such as Korea, Singapore, Australia, where credit penetration is higher, but you're compensated for that with a higher dividend yield and generally lower valuation. So there's a nice range of banking sectors to pick from within Asia, whether you want high growth ones or ones more focused on yield at that particular moment. On the next slide, I try and answer a question we get quite a lot, which is why we're so positive on semiconductors. And I think there's 2 points. One is structural and one is cyclical at the moment. The structural side, I think people are fairly familiar with, in the sense that there's a lot of increasing silicon content in all sorts of consumer goods and manufactured goods that are happening at the moment around digitization, the move to cloud-based applications, and of course, more recently, 5G and AI becoming must-have applications for many companies and many consumer devices. And where is the manufacturing base for all these chips that are required for these advanced functions? Well, most of it is actually in Taiwan and South Korea. Taiwan specializes a little more in logic chips, and South Korea in memory chips, both of which are crucial for these applications. So the structural side is very positive. A lot of the value that's accruing in these companies that everyone's heard of, like NVIDIA, those are actually accruing also to the manufacturers of these devices, which are based in Asia and may not be household names, but are crucial in the supply chain. And then looking just cyclically on the chart on the right, we are coming out of a pretty deep down cycle in the semiconductor cycle. So at the moment, the companies which have just worked through a number of years of rising inventories and having to slash prices to shift those inventories in the post-COVID recovery, those inventories have now normalized to an extent, and we're seeing numbers pick up for things like exports and end demand. So both structurally and cyclically, we're positive on that space. So I think I've talked long enough. I'll stop there. The rest of the presentation has those important disclosures, but I'll be happy to take any questions that you have.
Okay, coming to questions. First up, just a clarification on the region that you're active in. Japan isn't part of the mandate for the trust. Is that correct?
That's correct. It's Asia ex Japan.
Okay. So first question I've got then is about the rise or the domestic consumer, domestic market versus international market for your portfolio companies. How much of earnings or can you give a view on how much of your portfolio is geared for the domestic market and how much is for the international?
Yeah, I think that's an interesting question, because when we look at it, and it can be quite hard to actually break down where the end demand goes, because actually quite a lot of companies are part of that regional supply chain. So actually, when we look at things like where have Chinese exports been shifting, if you look at just the headline numbers, it does look like a lot more of those exports are going to emerging markets. But if you then look a little bit further down and see, okay, but where are the exports going on from those emerging markets? And it tends to be that quite a lot of those are ending up still going to developed markets, the US and Europe. So I'm a little bit reluctant to put hard numbers on that, just because actually when we look at it, what we've seen in the last 3, 4, 5 years is a shift in supply chains and a lengthening of supply chains, rather than necessarily the end demand changing. I think actually, to be frank, Asia still is a manufacturing hub for the world, and the end demand is still largely coming from places like the US, places like Europe. It just is that the supply chains are shifting a little bit, and you might get some of the supply chain moving from China to Vietnam, say, but actually the source materials still do come from China, as an example. So I'd say the end demand of the Western world is still very important for Asian companies. We do have, obviously, if you look at things like financials, most of that is driven by the domestic economy and domestic demand for credit. So some of that is clear, but in terms of the manufacturing and export side, it's becoming a bit more of a complicated picture, especially as tariffs have been introduced and some of these subsidies are being brought in to shift manufacturing to whether it's friendlier countries or nearer to the end region.
Okay, next question is about the investment process. You have your teams out on the ground, the analysts in the region. And they're giving you ideas. How often, how much disagreement is there? And what would normally be a reason why you would reject an idea from the guys on the ground?
Yeah, it's an excellent question. Schroders has a very long history and a big business in Asia. So we're not the only funds at Schroders, obviously, that invest in Asia. And there's lots of different fund managers, lots of different mandates that look at the region, who are drawing from the same research from the analysts. So I would say the analysts do have a framework which they look at, which is consistent, which I talked about in terms of the quality and returns on invested capital framework. When it comes to their recommendations, often they're recommending stocks within their sector, within their geography, and sort of ranking their best ideas. It may happen to be that our own requirements or our own mandates don't necessarily align with that. So it tends to be that not that we're disagreeing with the analysis. I think there's a lot of back and forth, a lot of good dialogue to understand their recommendations. But it may just be that actually their recommendations don't really fit with with how we're positioned. If we already are quite heavily positioned to one sector, one theme, where we have better ideas from another area. That may be why one of their ideas doesn't go in, but it's rare that there's a fundamental disagreement on the actual research of the stock, because it's a two-way process. It's not us just sitting here passively ingesting their research. We have a good dialogue with them, and we share obviously our views. We travel to the region, we meet companies as they come through London, and therefore we're always feeding back to the analysts our own views as well.
Next question, does the trust pay a dividend? And if so, what is that, please?
Yeah, it does. We pay out substantially all of the income received. Clearly, we don't have an income mandate, so the dividend does vary. I think roughly it's in the sort of 2 to 3% range generally, but that's not guaranteed, and that fluctuates with income. We don't have a requirement for the return of the fund in terms of whether we're getting that from income or from capital gain, so that can fluctuate.
And on the kind of same question, I think, is the trust at a premium discount, discount in today's market, and how's that relative to your peer group?
Yeah, it's at a discount of roughly in the region of 10-11%, which is not unusual. I mean, the peer group is very varied, I would say, in Asia. There's trusts who have very different approaches to investing in terms of style, different universes. As you covered in your first question, the concept of Asia can be quite flexible. You've got trusts that include places like Australia as in their reference benchmark. So it does vary, but what I would say is, discounts generally in the sector have been widening, and we see that it's not unusual for trusts, even that historically had been at premiums, have moved towards discounts in Asia over the last few years. Next
question is about sell discipline. I guess it's quite straightforward. And why do you sell? What's the motivation to exit or to kind of take profits?
Yeah, I mean, there's broadly two reasons to sell. One is good, which is the stock's done well, the investment thesis has played out, the valuations have moved to a level where we're not finding much upside. Even if it's a company we really like, our analysts tend to do scenario analysis. They'll look at what we call a blue sky scenario. If everything goes perfectly well, how does the valuation look? If a stock, how much we like it, how good the management is, if those valuations are pricing in such a blue sky scenario, it doesn't really make sense to hold on to it, because you need a margin of safety, and we can never fully know what's going to happen. So that's the good reason to sell. The less positive reason to sell, and it does happen, is that we've got it wrong. The investment thesis hasn't played out. There's been a factor or a risk that has come to the fore which we underestimated or overlooked, or the analysis on things like company structure. There's been disruptive technology which has disrupted the industry structure. Those are some of the reasons. So if a stock's going down and the reason for that is our investment thesis has been wrong, then we will also look to sell.
Abbas, thank you. We're out of time there. Thank you very much indeed for joining us this evening.
Thank you very much.